Hi everyone, this is Tim Melvin of the Tim Melvin Banking on Profits Report and the Deep Value newsletter, coming to you from what's been another great day down here in Central Florida. 85 degrees, no humidity, and I spent a lot more time out in it than I usually do. Had a ton of errands to run today, picking up stuff, getting the wife's computer fixed. So I've been out quite a bit, and now I'm rushing here at the end of the day as we just put the final touches on this month's monthly Banking on Profits Report, which will be the 13F issue. Going over all the bank stock activists and specialist buying activities in the third quarter of 2015. And that's pretty valuable information to have. We know from the Stern Agee report in 2014 that when an activist gets involved in a community bank stock, it has a significant effect on the future price performance, and the returns are quite high. And we've found that out in practice over the last years. Our main core banking on profits portfolio is up almost 20% over the last 52 weeks in what can be generously called a not very good market. One of the bigger pieces of news that I saw today was news from the Reuters Global Investment Summit being held up in New York City. And Mark Lazary of Avenue Capital, if you're not familiar with him, he's a noted, very successful distressed debt investor. And he talks about what he sees across the distressed and high yield market right now. And he said something, and it's a variation on a theme that we've heard from a lot of the guys that are in the distressed debt area, that he thinks that energy debt right now is a once in a lifetime opportunity. He said, usual warnings, he said it's only for the patience types. The quick money probably should not be involved in this because they could very well go down before they go up. But he has an energy opportunity investment fund that raised a few $1 billion earlier this year, and he's just put 5 to 10% of the proceeds to work in battered energy credits over the course of 2015. And he says it's a win-win. You either get paid off, the bonds stay current, they keep making their interest payments, or you walk away with all the equity in the company. Either way, from current prices, it's likely to be a home run for patient investors with that 5 to 7 year time frame that the private equity and distress types like to talk about. We've been looking at some energy debt. Really do agree with him. It's you have to be a little better with a pencil than most folks really are to get involved in this space. But if we run across some, you got to own that credits. We'll talk about them some in the weeks and months ahead because some of them are very cheap. I found some credits trading between 30 and 40 cents on the dollar that I actually think have a very good chance of continuing to make their interest payments and going up to par when oil prices eventually recover. Reminds me very much of technology debt following the big internet boom, blow up back in 2001, 2002. When we were, buying Amazon convertibles at 30 cents on the dollar, and there was just paper everywhere trading at 30, 40, 50 cents on the dollar that eventually we sold for par or more 2 to 3 years later. So could be an opportunity here. We're going to cherry pick his portfolios as to the best of our ability, and we'll be looking at the space because I do agree with him. With trading where they are right now, it could very well be a once in a lifetime opportunity. Now, does that apply to equities? We've been talking about that. Of course, I've been long and wrong the oil stocks pretty much since 2014. We got in, never crossed our mind oil could drop down to $40. We very much found ourselves agreeing with T. Boone Pickens that oil would probably recover and be back at $60 to $70 by the end of 2015, and perhaps even higher than that in 2016. We were wrong, and we own, we're not buried in it, but we have a good position in oil, and we've stuck with it. That makes us wrong. So we've got to pick a point here to double down. We'll probably do that if oil breaks much below $40, because I really do believe that the 5 to 7 year outlook for oil and gas stocks is actually pretty bright, especially those with strong balance sheets that can survive long enough to thrive once again in the future. Anyway, Boone was at the Robinhood conference up in New York earlier this week, and he was interviewed by Bloomberg, and he told him, you know what, I was right. I shorted it from 98, on down to probably below 60. He covered it. That was great. He got back in way too soon, and he admitted it. He said, look, I was wrong. And if you look at his 13D filing, he took his being wrong very seriously. He blew out a huge percentage of his portfolio, and it looks like he's got a lot of cash on hand to take advantage of opportunities if, in fact, oil prices do continue to decline. If you look at the 13F filing, sorry, not 13D, 13F filing, he had 27 sells in the quarter, mostly larger cap names, and he had 9 buys, mostly smaller cap energy names, and he talked about these in the Bloomberg interview. By the way, he said he's flat oil, has no direct exposure to WTI oil. But all of these he feels have special situations, special properties, and so he was buying these stocks, and these ones that he bought in the past quarter currently make up about 53% of his portfolio, and it looks like he has between 30 and 40% of cash on hand to get back into energy-related equities if he should so choose. Anyway, not going to make you go do the filings. Here's the stocks that he was actually buying that he thinks have are special situations or have a significant advantage that makes them worth owning even as oil prices are declining. So let's read these off. You've got Synergy Resources, that's SYRG, EOG Resources, cleverly the ticker is EOG. You've got PDC Energy, that's PDCE, Pioneer Natural Resources, that's PXD, Parsley Energy, PE, Cimarex, that's CXO, one of my favorite stocks that I'm stuck with, WPX Energy, symbol WPX, amazingly enough, Concho Resources, which is CXU, and Diamondback Energy, which is FANG. Now, we've not been through all of these by any means. We've looked at Pioneer Resources recently and passed on it. We do own WPX Energy, and it's going to be one of the ones we'll be doubling down when we finally decide we're at the point of maximum pessimism in the oil market. So, anyway, there's Boone Pickens. He's telling you, look, I'm sorry, I was wrong. Although he did remind the anchor, he does still have a month to go for oil prices to get back up closer to 70. I don't think Santa's bringing that, Boone. We're just stuck in this stuff. Got to pick a point to double down. At some point in the future, we'll be hiking and tall cotton with our oil positions, to mix a couple metaphors there for you. Now, Blackstone, the large private equity firm, they had their vice chairman was at the Reuters Summit, and he said, Tom Hill is his name. He says that he thinks that in 3 years we'll see oil at around $60, between 60 and 70. Could go to 21st. That's a real risk. I would take that because if oil broke down at below 30, I would be a very aggressive buyer. It would make my decision on doubling down very, very easy. Boone says he doesn't think it's going to go much below 40, but he was just wrong on the last one. So we'll see what oil prices do. We'll pick our point. We'll double down. And then if we get to 60 in 3 years, we're going to be some very, very happy folks. Now, one thing I did note, one of my regular processes is to sort through all these 13F files by noted activists, distressed, and value investors. And I will tell you, I did not see a lot of energy-related buying. There was a little bit, and I'll talk about some here in just a second, by an investor who I've committed some acts of high piracy for huge profits over the years by tracking his 13F filings. But this goes on in effect. We're still not seeing a lot of insider buying in energy-related companies yet either. So we're not seeing the activists. There's said to be some that have raised a little bit of a war chest to go after them, but they've made no moves yet. So there's a consensus among the very smartest folks out there, and I'm going to jump in with them. I'm going to be the dummy in the room that thinks that oil could very well go lower before it does, in fact, turn around and go higher. When we're comfortable that we're within shouting distance of a bottom in oil, we'll go ahead and double down on our existing energy stocks. Now, David Nierenberg of D3 Funds, first saw him at the Value Investors Conference in New York City. I'm going to say it was back in fall of 2008 or 2009. I don't remember which one. But he talked at length about looking for stocks that can return in multiples, not percentages. And that's always kind of been my shtick. I've stolen the phrase from him and used it on numerous occasions. And I lifted a couple ideas from him at that conference that eventually did, in fact, triple in value over the next 3 or 4 years. So he runs an incredibly concentrated portfolio. I think he has 6 or 7 stocks total right now. He's an activist, but he prefers what he calls friendly persuasion. He prefers to work with management, kind of on a collaborative basis to get the company turned around and get the shareholder price higher over time. And he seems to have been pretty successful at it. At least the ideas I've lifted from him have worked out pretty well. He's one of the very few guys, he stepped heavy into energy during the third quarter of the year. He was buying C&J Energy Services, which is actually a stock I made money with coming out of 2009, primarily products and services for the fracking industry. So you can imagine how hard they've been hit. But the stock in an oil recovery, could triple, quadruple, or more as long as they are able to survive until they can thrive. And with Mr. Nierenberg as a significant interested shareholder, I think the chances of that have increased somewhat. He also, this is a name that keeps popping up, I keep coming back to it, saying not yet, is they provide, Geospace is the name of the company, GEOS. They provide products and services that help companies gather seismic data for the oil and gas industry. There's no exploration going on in the oil and gas industry to speak of right now. So frankly, business is horrible. So we'll see how this one works out. I think you're going to have to be very, very patient. The stock has fallen a very long way, recovering even half or more of the decline over the last couple of years would mean a significant profit for investors brave enough to follow Mr. Nierenberg into the space. Then there's one. You say this one's for all my Maryland friends up on the Chesapeake Bay. He has been a consistent buyer over the last year of Malibu boats. They make the Go Fast boats that roar up and down the Chesapeake Bay. And when I lived up there and was single, I was usually a passenger in one of them. Not coordinated enough to ever have driven one of them, but I did love to ride around and just go bar hopping around the Chesapeake Bay at 60, 70 miles an hour in a boat. That's just a ton of fun. Although as you get a little older, it is tough on the knees, I will tell you that. Anyway, the bank stock activists that we follow, they were pretty active. We didn't see a lot of selling. Even the guys that did do a lot of buying are holding pat to their positions unless there's been a takeover. There was significant buying from several of the firms. These are worth tracking. We do that for you in the Banking on Profit monthly subscription for a pretty reasonable price of $199 a year. We stay on top of that. We stay on top of the insider buying. And we keep you abreast of what's going on in the industry itself and what some of the bigger fund managers and analysts have to say about community banks. So, looking at the 13F filings, trade of the decade still very much alive. No need to pause. We're experiencing terrific results with the banks that we've been buying in the main portfolio and the ones that we've offered up as bonus picks or what we call focus picks in the monthly edition of Banking on Profit. So by the way, we've got a pretty good one in this edition, courtesy of Nate Tobik at CompleteBankData.com. He's been generous enough the past couple months to let us steal an idea or two from him, and he's given us some nice write-ups on the banks involved. So anyway, that edition should be out in the next day or two. We just got to get it the finishing touches, make all the pictures pretty and all that for you and get it out to you. So right now, nothing much has changed in my outlook. If you're bringing new money to the market, community banks are the place to be. Maybe a couple of special situations. I've talked about that, a couple recently. Love Volt Information Sciences here around $8. I think Unisys is an absolute steal. This is going to be a $40 stock 3 years out, I believe, when they've got the cost cuts at full run rate by the end of 2016, this company is going to be making a lot of money. Add their stealth product for cybersecurity that they're going to be selling to banks, and I think that you're going to see a very strong turnaround in shares of Unisys going forward. So there's a couple ideas, throwing out a lot more stock ideas and tickers and names than I usually do, but not all mine. I gave you two of mine that I really do like. The rest of them are stolen from other ideas. If you were willing to spend a few hours sifting through all the 13F filings, you would have eventually uncovered them anyway. So, I've got a new project coming out that I've been working on real hard, doing some writing about it, testing it. We'll talk some more about this next week because it's fun. Not quite sure what we're going to do with it yet or how we're going to incorporate it. But we've been building a model that combines strict value investing, stocks below book value. But we combine it with momentum factors. And what we found is, to a very large degree, momentum almost acts as a safety check because you're buying the ones that are going up, which means institutional investors are starting to recognize that the fundamentals are actually improving for these companies, and they're moving the type of money in that applies what Louis Navellier likes to call buying pressure to these stocks. One quick observation I'll share with you on that. I'm going to talk more about this next week because it's kind of fun. It's been interesting to do. So we haven't figured out exactly how we're going to incorporate it, but we're going to incorporate it somehow because the results are very high. They're consistent. Drawdowns are less than the broader market. It's a pretty cool combination. So we'll be talking about one observation. You want to guess which group has been most heavily represented in undervalued stocks with momentum over the last 10 years. Community banks. Guess which ones were not in there at the end of 2007, first part of 2008? Community banks. So again, the community bank space, if you're not in it, you're committing a major sin of omission. Okay, you need to have these in your portfolio. If you combine a few simple fundamental factors, along with price to book value, a little bit of balance sheet and loan portfolio analysis in favor of those that have an activist investor in them, you have basically been dealt a pair of aces every hand at your local poker game. You're probably going to walk away with a lot of money over time. So it is a lot of work. I can't kid you about that. But as I said, for $199 a year with Banking on Profits Monthly, you can stay up on it. If you want a better guided portfolio where I do all the work for you and hand you the list of names to buy, well, then you can get the regular Banking on Profits service. Anyway, the holiday book publishing catalogs are coming out. Just tons of stuff to read. So my Kindle's just loaded. I just hope someday to find time to be able to work through all of it. We're taking Thanksgiving week off, so I'm going to be down in Naples, so maybe I can get a little beach reading time in down there. Not much going on in the world of sports. The Ravens are horrible. Navy is on a roll. I believe they're 8-1 now. Keenan Reynolds is a legitimate Heisman Trophy candidate, the quarterback. He's now got the all-time NCAA touchdown record. Broke that last Saturday in yet another win. Wouldn't that be great to see somebody with the character of a senior midshipman at the Naval Academy win the Heisman Trophy with no intention of marching off and trying to cash in on it at the NFL draft, because you can't. He's got to go be a Navy officer for 5 years. So I'm kind of hoping he gets it. He probably won't, because Navy football's not Alabama or Florida or some of the great big football schools, but that would be kind of cool. If you're not following Navy football, you should be. This is a tremendous program run by, of course, the United States Naval Academy in my hometown of Annapolis. They're doing good things. Those great young men and women of the academy, if you've never been to a game, it should be on your bucket list, because just to stand there and watch the 5,000 strong brigade of midshipmen march onto the field in full uniform with the jets flying over, and all the admirals and Navy officers, and it's just a tremendous, almost emotional event. I've taken friends to them over the years, and they've always been very grateful that I suggested they come into town for a great game when I lived up there. So anyway, that's about all I've got going on down here this week. In Florida. Looking forward to another busy, productive week. We've got the issue of Banking on Profits Monthly getting ready to go out. We've got this new value momentum project we're putting the finishing touches on, and the weather is still great. We've got plenty of books to read. Life is good. Community banks are going up, and someday we'll get to put our cash to work, double down on energy stocks, and find some other bargains. Looking forward to a strong 2016 for both portfolios. So anyway, I'll talk to you guys next week. Have a fantastic week, and I'll talk to you soon.